All right, welcome back to another episode of Bitfinex Talks. Today we have a very special episode. We're here with Adam Back from Blockstream and Paolo Ardoino, the CTO of Bitfinex. And I also have a co-host for this episode, Jesse Knutson, who was formerly with Blockstream and is also with Bitfinex. How's everybody doing today?
Pretty great, thank you.
Good.
I wanted to start this off with a question about sidechains. I've seen a lot of discussion lately about Paul Stork's drive chain. And since I'm here with Adam Back, who is responsible for Liquid's Bitcoin sidechain, I wanted to get his opinion on it. Paolo, feel free to chime in as well. Adam, what's your opinion on drive chain?
Yeah, I mean, I think it's, it's interesting. And of course, people always prefer a more decentralized and more permissionless technology. So the current Liquid sidechain is federated, which is a trade-off that can be implemented. And, it's been in operation for some years now, without requiring a soft fork, to add some extra features to enable it. And the drive chain is a more sort of peer-to-peer version. And, there are a few variants of that. So Blockstream published a sidechain paper back in 2015 or so, where we had one method to do this, and a drive chain is a different variant of it. So I think in an ideal world, eventually there would be enough kind of opcode flexibility that you could implement, a few different variants of sidechains or something like that. Now, opcodes in Bitcoin are usually intentionally sort of generic, right? They could be used for this, but maybe somebody will find a use for it for some other layer 2 or some, vault or something, right? So it's a quite complicated kind of language opcode design thing. So those kind of things take quite a long while. But Paul Stork has been working on it for a while, and he has a specific, he has it implemented. He has BIPs, and it's a source of discussion. And of course, consensus starts from people discussing trade-offs and alternatives. So he's made that start.
Yeah, in my opinion, it's really a big philosophical choice where there is the concept of Bitcoin is almost perfect as it is, and there is always risk in changing it and adding new opcodes or features that could definitely, of course, expand its feature set and allow drive chains and allow many other things possibly. But where we are going to draw the line, and I'm not saying no personally to drive chains, of course, it's just more like a question that everyone should ask themselves, because if we say yes to this change, we need, there will be many more changes that could be cool to add, but how we can perfectly predict what impact would these changes have in long run on Bitcoin. So that's, I think, why there is a lot of anxiety and concern by the community around adding support for these bits.
Yeah, I mean, I think it's actually a very interesting topic for other extensions too. You see a similar thing. So there's been quite a bit of discussion about covenant opcodes in Bitcoin over the last couple of years. And Liquid has some covenant opcodes actually, so people can try, one variant in there. Actually, as a second iteration. We've had it for so long that there is some developer experience, and then we added some more functionality. But when it comes to Bitcoin, yeah, I think people they want to know if it's safe, and they want to know, understand high-level things like, does it adversely affect the incentives for security and mining? If there was a lot of money, a lot of assets, shares, cash, or stable coins in a merge mine, like a decentralized sidechain, might it cause miners to try to undo something, right? Or force them to receive a lot of bandwidth? So there are all these questions, and they're quite open-ended.
Adam, I just wanted to ask quickly, with Liquid's covenants, what additional functionality does that enable? What benefits would I as an end user have by using them?
Yeah, I mean, actually, they're a kind of general programming tool, actually. So they end up being quite powerful and really extending the scope of things you can implement using Bitcoin opcodes. I mean, Liquid has Bitcoin opcodes plus a few extras, plus native asset support like stablecoins as Tether and other stablecoins. But it also has a few other opcodes like opcat, which Bitcoin lacks. It was disabled early on in Bitcoin. And in the covenant mechanism we have, the original one is like check sig from stack. And so you can, basically there's not enough introspection in Bitcoin to quite assemble a covenant being, a restriction on a transaction about what the transaction after it, the script of the transaction that follows. So you can have sort of, you can place a restriction after sale after transfer. And that turns out to be a general programming technique you can do all kinds of things with. So I mean, we've used it, for example, to make a variant of that trustless trade I described. Well, so there's possibility on Liquid to do trustless limit orders, and typically that is, I mean, that's very easy to do because it's just the inputs which are Bitcoins have to add up to the outputs which are Bitcoins, and the inputs which are, let's say, Tether have to add up to the outputs which are Tether. So it's kind of extension to Bitcoin rules, but those are kind of, you got to buy the whole coin. There's no change making or partial matches, right? And so with covenants, we have a scheme to actually implement an offline partial match, right? So I can nibble a bit off an order, and the covenant is basically saying, well, you can do that provided that the change goes to another limit order with the same terms. And so there's enough with the covenant and introspection codes. There's enough to verify and enforce that's the case. And so that means that anybody can take a partial order off it, provided that they put the change into an order which gives the same benefits per coin to the seller, right? This is an example, but you can do lots of things. You can make vaults. It's a general programming construct.
Adam, I just saw that you guys completed a $125 million raise to expand your mining facility. So I was kind of, wondering how you guys are going to look to execute that expansion in terms of product and maybe geography as well.
Yeah, I mean, so I think one thing that people are seeing in the market, particularly last year, is that mining profitability dropped a bit as the Bitcoin price was down. And some of the prop miners, so people who are mining for themselves, took a lot of leverage against Bitcoin. And we all know that over leverage against Bitcoin can creep up on you. And also they took leverage against ASICs. And it turns out that ASICs dropped much further percentage-wise than Bitcoin did. And there were people that used, Bitcoin miners, ASICs, as collateral. And so that created some problems. So there are some companies having troubles. But contrary to that situation, Blockstream is on the other side of the business. So we provide the hosting for miners, for companies that are doing mining. So for example, Blockstream hosts Fidelity, digital assets miners, and other funds in the space. And so on that, and we didn't have any, Bitcoin debt or miner debt and so on, right? So, but what's happened in the last year is that last year there was, the Bitcoin price was high, and a lot of people made orders for miners, and you have to prepay and pay long in advance. And so, with the price correction, they're still receiving the miners, and there's a shortage of power. So even though mining profitability is down, hosting demand is enormous, and there's a big backlog and equipment depreciating in data centers. Just in storage facilities, basically, new on pallet, as they say. And so what we have been doing for the last year is doing the preparatory stages to expand to new mining locations. So new sites adjacent to or very close to large low-cost sources of power. So we have about 500 megawatts across multiple sites at a stage where we can put money on the ground and build out the infrastructure. And the infrastructure is containerized, and we have a kind of pipeline process to do that. And it has actually a quite good margin, but it's capital intensive, hence raising money. So we have people queuing up to buy power, and that's across the industry, to send miners and power them up. but there's a shortage of it. So we're trying to, get market share and satisfy that demand with our modular deployment strategy.
Yeah, it's funny that there's a bottleneck around power, because even within North America, there's still a lot of power, right? Like Blockstream mining started in Quebec, where there's a lot of hydro, but it's difficult to access because of the politics. And we've seen, different parts of North America start to, take kind of a negative stance towards Bitcoin mining. My home province of British Columbia recently had some news out. New York had some negative news out recently. So do you guys, does Blockstream still want to focus on North America, or do you look at maybe diversifying a little bit geographically?
Yeah, I mean, we actually, our first mining farm many years ago now was in Canada, in the Quebec province. And the early, and there was a time when we started very early in the cycle, but there was a time where they were actively, soliciting for mining companies to come to the province and, as a business incentive, but because the power company is government owned, and for the employment and construction jobs it would create. And so, that went on for a while, but then, as you said, the political climate shifted, and there was, sort of some confused data, and it became political. So at that point, going back quite a few years ago, we started diversifying into other geographies. So we have a couple of locations in the US, and we're looking to expand more. And we're also, have active conversations more internationally for diversification purposes.
Yeah, I mean, hash rate has really changed a lot, the composition, the geographic breakdown over the last couple of years, right? So even, 2 years ago, maybe it was as much as 80% was China, and then we had the rise of North America, Kazakhstan. And Paulo, you were in South America recently. Did you have a chance to interact with any miners there? Do you think there's an opportunity for maybe South America to take a bigger chunk of the global hash rate pie?
Well, first of all, I think is long due that we are actually seeing a walk towards an reduction of concentration of mining in the US. So that's something that is a bit, in general, scary, right? No one was happy about having so much hashing power coming from China, and we shouldn't be pleased as well from seeing that coming from the US. So I think it's the more diverse geographically, the more resilient it should be, right? So Bitcoin should be. So we have been visiting different countries from El Salvador, Uruguay, Paraguay. And definitely the beauty of it is that there is a ton of natural resources to do 100% green mining. Uruguay, for example, has the entire production of the country, or almost the entire production of the country, is from hydro and from solar and wind. And then also Paraguay has the biggest dam in the world that produces up to 14 gigawatt, right? So so there is so much potential, and also not non-optimized potential. I mean, with producing 14 gigawatt means that you are in a situation where for a good part of your time you are actually not reusing that energy properly. You are wasting a ton of energy because at night will not get used and so on. So I think I think we are going to see more and more traction in South America about on mining using renewable energies, and that I think is the right way to go. So with Tether is definitely looking to that with Bitfinex, and we are always working and discussing with Blockstream as well about mixed opportunities that we can have there.
Well, why has South America been kind of late to the game? Because if they've got the hydro facilities, is it the other infrastructure around that? Is it things like transformers and internet connectivity? Is it that stuff that's kind of made them a little bit, because miners went into Kazakhstan fairly early, they went into all different parts of the world, and South America seems to be one that you haven't heard that much about.
That's a good question. I think that it's probably you had Texas that was offering already super cheap energy, and then they got extremely they decided people saw that opportunity. Texas has good infrastructure, and it was super easy. It was a super easy step. So I think that the reason is that sometimes South America is a little bit harder to understand, and for investors to come in and understand where to start from. But going there and being there, I actually can testify that it's not really the case. Everyone is extremely welcoming, and everyone is super excited to do business, to look towards shared opportunities. So I think it's a kind of, unfortunately, a misconception that many entrepreneurs could have had in the past, but I think it's going to change pretty soon.
I should clarify that, when I say there's a shortage of power for mining, it's a shortage of ready-to-use power. The missing thing is the racks and the transformers and the cooling and the switchgear, right? Because there's lots of underused power, like not used to its full capacity, because most capacity planning is based on the peak use, and so it typically goes under half used in most places, right? So there's typically an enormous amount of power that is not being used continuously. And so, yeah, I think the gap for a lot of places is that, the gap for currently is not, there's plenty of power around, and Bitcoin can mine anywhere. It's that it takes a lot of capital to build the infrastructure. So to buy the transformers, to do the electrical installations, the filtration, cooling, etc. And I think that the Bitcoin mining sector is undercapitalized, and the reason for that is, if you look at any other industry like cars, computers, mobile phones, etc., there's a whole area of finance behind that, which is providing factoring or working capital loans to fund the development, the manufacturing, to build inventory, to sell, and that's the whole cycle there. And that cycle is largely missing in the Bitcoin sector because it's so new, and conventional finance historically has, not understood the asset class, or viewed it as high risk and so extremely high interest rates. And so you see that throughout the system, right? Both on the trading side, on the margin lending, there's a huge gap between Bitcoin related margin lending and stock and share margin lending on brokerages, right? The interest rates are double digit versus single digit low, right? And it sort of pervades the other aspects. So apart from the mining infrastructure, also the manufacture of miners, no miners are selling you miners from inventory in a normal market. And so they are asking the customer to make pre-orders and payments in stages, because they're basically using customer financing, because they can't get factoring or corporate debt or any of the usual kinds of financing. And also the foundries, the people they would pay to do mass production, the actual assembly companies are less likely to give credit, like manufacturer credit, and the foundries are less likely to give credit because they view it as a risk sector and they don't understand it. So I think those things are gradually improving, and some sort of forward-thinking people from the conventional finance world are, starting, I would say last year, and it's improved from there, to get more active in the space and understand and provide financing. So that might improve some of the liquidity problems. And I think that also underlies the over-leveraged nature. Like, people needed to expand, and they needed the capital to do it. And so they took it from the only place they could, which was, the Bitcoin and the miners, which was a high-risk thing to do.
Yeah.
Now, normally in any other sector, they would have used conventional corporate financing. So that's part of that structural, I think the Bitcoin sector's structural problem in the short term.
I had a quick question. What impact does the climate in South America have on perhaps limiting the mining industry? As I understand it, in El Salvador, they prefer like liquid cooled miners rather than air cooled miners, and the infrastructure is totally different for both setups. Do you think that's a limiting factor, that there's not enough liquid cooled miners being manufactured to meet the demand for a South American mining industry?
there are two methods of liquid cooling. One is for the miner itself to have its own integrated liquid cooling block, kind of like overclocking kits for desktops kind of thing, right? You can get an overclock cooling block for a CPU or a GPU that has integrated water cooling. So there are a few manufacturers doing that, but most of them are kind of aftermarket water cooling. So they'll basically make a tank and remove some parts from the miner and immerse it in the tank, and then they'll fill up a container or a warehouse with these tanks, and then they will have a sort of secondary heat pump that extracts the heat from the cooling fluid and vents it like that. So I think the challenge is really that it's more expensive to do immersion and liquid cooling, and it's relatively new. So there's less mature technology for doing it. I mean, it is a technology used in other sectors, but for the Bitcoin sector, it's relatively new, and things in the Bitcoin sector tend to be a bit unique because of the power density. I think Bitcoin power density per square meter of data center space is quite a bit higher than AI workloads or conventional data center. So they tend to need higher capacity heat extraction technology.
So the big pinch point that we're back to is funding again. I guess that's historically been the big problem for Bitcoin miners. I think that's actually the reason why China blew up so big in terms of hash rate, is because they had easier access to that first generation capital. They could write a check faster than the more institutional money in the West. And I guess 2021, we saw a lot of those companies go to public markets and then raise money that way. And then the pinch point was the ASICs. Nobody could get allocation from TSMC or Samsung. And now it sounds like we're back to funding as a problem. So I wonder, like, what were the lessons? What are the lessons from 2021? If everybody got a little bit overextended, what do you think the lessons are for Bitcoin miners?
Well, I mean, I think it was partly self-inflicted in the sense that people can always choose how much to balance from reinvestment to expand to capture market share, which is risk on, versus operate conservatively within the working capital, right? And so I think too many people in the prop mining part of the business were risk on, capture market share, and used a lot of leverage to do it. So that kind of eventually built up. And of course, a mining investment is like time delayed. So they will put capital to place pre-orders for miners. Normally they take about 6 months to get manufactured because of the foundry. The foundry process itself takes 4 or 5 of those months. So it's an unavoidable fact. But so they have to make a purchase decision. Like the manufacturer hasn't got inventory. So you have to make a investment decision. You're going to spend $10,000 on this model of miner, and normal market, you get that in 6 months, but because things got very hot last year, earlier in the year, the pre-order there was a shortage of miners, and so the pre-order time period went up from like 6 months to 9 months to 12 months, and once it started, that equipment is coming regardless, right? So now I would say that probably the manufacturers have inventory. Some people who are prop mining have inventory because they were over optimistic about securing hosting to put their miners online. So it will take a little while for that equipment to get online, and then we'll be back into So I guess it sort of swings between there's going to be an excess of something or other, right? As an imbalance. So currently excess of miners. Eventually we'll go the other way, where there's a shortage of miners.
So I guess that's what's pushing hash rate higher at the moment, right? Like we've kind of had highish hash rate despite weakish price. Is that delay between people ordering the equipment and then it being delivered and then finding hosting to be able to deploy the equipment.
Right.
So do you think the relationship, and then in 2021 we had price go up and hash rate stay flat. So do you think the breakdown of the correlation between hash rate and normally hash rate follows price. So do you think that correlation has broken down a little bit over the last couple of years?
Well, I mean, it is it does follow, but the capacity to match the economics lagged due to supply chain capacity, working capital, and the time delay increasing. So of course, once people have bought the miner, they're in a sunk cost situation where where they may not choose to buy a new miner, or not the price they paid before, but given they've already paid for it, now they have an incentive to put it online as soon as they can, because it will make an incremental profit. And so that lag and those machines coming online is why the hash rate is continuing to grow at profitability levels where there wouldn't normally be a lot of fresh miner purchases happening if miners were available in inventory, right, as a normal basis.
So shifting gears slightly, so what are your thoughts on Ordinals? And this kind of relates to Bitcoin mining as well. So Ordinals is this project that's issuing NFTs directly onto the Bitcoin blockchain. I think it's kind of interesting to me. This sounds a lot like Satoshi Dice from 2013, 2014. So I was wondering, Paolo and Adam, like what do you think of that? And should, I guess, Bitcoin miners use transaction fees to filter spam? That's how you keep the spam out. Should they be doing additional filtering on top of the transaction fees?
Well, that is this is quite a hot topic lately.
Yeah.
I know that Adam has had some interesting opinions. I lean towards what Adam suggested publicly, in the sense that it's not about suggesting to miners that they should go on full censorship. So it's about freedom of miners, right? So some miners would feel that some transactions are just spamming, and they could decide to not include them in the block. Others might be perfectly happy with being paid higher fees to include some hashes or cut JPEGs in the block space, and then they would do it, right? So eventually is just a pure game theory, and is just a pure concept of pure philosophical concept. It's not just no one wants to suggest that there should be a full on-chain censorship layer. But I think that if I was a miner, I mean, there are miners that eventually will be more and more kind of mercenary miners, driven by the pure economics part, and that's perfectly fine. Others might be still at least the OG miners, and are more probably interested in making sure that Bitcoin will thrive, and they are more like oriented to the Bitcoin ethos, and they care. They might decide that some transactions are not worth storing, and that's the beauty of it, right? There is enormous freedom in among miners. Everyone can decide what to put in a mining block, and that's how it should be. That's also a feature, right? So there is no way to control and to tell and force miners what to do. It's just about communication and ideology.
How was Satoshi Dice resolved? I don't remember how. I couldn't find an answer online of how that was resolved. It sounded like a very similar situation, right? Where I think it was actually an Eric Voorhees company where they did online gaming, and every roll of the dice was going right on chain and just basically jamming up the whole network. So do you remember, Adam, how that was resolved?
I mean, I heard about it and the controversy. I'm not actually sure what happened. I mean, maybe the Bitcoin price went up and the minimum fees made it less fun.
And it kind of handles itself naturally.
Yeah, I mean, it's actually, the whole situation is kind of ironic for me, because the way that I arrived at, developing Hashcash a long time ago, right? In 1997, was another distributed protocol, which was for anonymity in posting to Usenet discussion groups and for email. And the challenge with it, as an operator, like a volunteer operator of one of these anonymity providing nodes, was that people would spam through it. And so, it wasn't commercial spam like, to advertise something. It was just random numbers basically. And so we thought, they're trying to create a blowback situation where system administrators of Usenet groups get annoyed about all this spam and then try to block all the remailers or something. So we thought it was actually hostile to, the utility function of the remailer, which is to provide anonymity. So the people who didn't like anonymity were spamming on it to discredit them, something like that. And so, normally with anti-spam, it's based on like heuristics and blocking IP addresses and blocking sender emails, but you can't do that in an anonymous system because you don't know, right? And maybe philosophically, from my point of view, email should be anonymous anyway. Like attaching your identity to it should be a optional opt-in. So in any case, it occurred to me that the fundamental problem was that email was effectively free, and so I designed this postage system to add a cost as a kind of a way to throttle it a bit. And so it's kind of full circle, right? So now people are spamming Bitcoin, to my point of view, right? Now, of course, as Paolo said, there is a philosophical discussion where some people will say, well, spam is a human judgment, and it's an economical system, so anybody who pays can do whatever they want with it, right? If you buy, a bottle of water or a big jug of water, they're not going to judge what you use it for. But if there's a country where there's a shortage of water and people are just pouring it on the ground because it's fun or something, it still might annoy some people, right? So I think the other context is most internet protocols. Paolo and I have distributed systems like computer science background, and most internet protocols are have to contend with denial of service, and so they have to do something, right? So apart from the resource limits that people know about in Bitcoin, or there's a block size and there's a dynamic fee, so if it gets very busy or over full, the fees go up. There are other limits, right? So there are actually on a peer-to-peer network, if the Bitcoin nodes are connecting to each other and exchanging transactions and blocks and things, and there's defenses in there, so if you get too much data from one node, the software will automatically disconnect it. If it sends you too many invalid things, it will automatically disconnect it. If there are too many things coming from the same or like similar IP addresses, like in a bank, it'll get disconnected or downrated. And so there's a lot of things there which are, if you wanted to be pedantic, you could say, oh, that's wrong. You censored this node because it sent an invalid transaction. It's my right to connect to the internet and send whatever I want, right? But the practical matter is that, there's a contention of interest here, and people are trying to make a pragmatic and useful thing work and be robust in an environment where you can't tell people what to do, and you shouldn't want to tell people what to do, but they can, right? So people will do things because it's fun, or to, mess with you, or for aesthetic reasons, like the Ordinals project guys are explicitly saying that, because one of the questions is, if you want to do something, you want an effect, right? Which is you want to, track the purchase of some certificate relating to digital art or something. And so, you could say, okay, fine. Like if you were architecting that, how would you do it efficiently? So maybe you put, a checksum in the chain and you transact that certificate, and there's a reference to, the actual art in another distributed system like IPFS. And there are systems that do that, right? But I think in this case, they considered the consumption of Bitcoin space as part of the aesthetic appeal of the art. So it's difficult to combat. So I think another factor which is quite fascinating, that's occurred many times in Bitcoin, there's a previous debate about op returns, that there are different people who program focused on different areas. So there are people who program sort of networks and robust systems, and there are people who build applications on top of them. And so sometimes the application programmers are trying to build, some kind of peer-to-peer app, and they just want like a bit of app data. And so they look around and like, well, how can I get this app data from like one user to another? Like, I know, I'll send it in the transaction, right? And so they're sort of using the blockchain as a peer-to-peer communication transport, where really it should just literally use that. I mean, topically, like Keats hypercore transport, right? So it's a general peer-to-peer transport, and that would be the efficient thing to do, because while you can, use the Bitcoin as a kind of application-to-application transient messaging transport, it's not optimized for that. And so, I think my conclusion on it is it would probably solve the problem if some people, got some developers together with the right skill sets to make an opt-in blob transport for Bitcoin, which is not part of the transaction history and not required to validate blocks, but it has references that you can place to transactions, and it's distributed. So basically, it's a kind of like custom blob transport opt-in profile, which some people can run and others not. And then, it would enable people who are app programmers to have an easy-to-use thing. Because I think part of the problem is it's just opportunistic, right? I want to do something, and it's hard work, and it's a lot of development work to build a peer-to-peer network. And so they just look around, and it's Bitcoin related, so they put it in the chain. And so I think
a lot of press as well.
Yeah, well, I mean, that's part. I mean, you've got for artwork, that's part of the appeal sometimes, to try and drum up some interest. So maybe that's part of the formula as well.
My question about ordinals for both of you is how it impacts fungibility by assigning a differentiator to an individual Satoshi. Doesn't this have like a negative impact on Bitcoin's overall fungibility?
That's a good question. I mean, to me, it's kind of to my understanding, is a layer on top of they are creating this additional layer that is not necessarily or proper, how I can define it, proper carried over by the actual chain, or there is no guarantee of this to be something that the blockchain will maintain it, or will have a meaning for it, right? So again, any information that you put or you store, it's how you interpret. So everything is subjective, right? So the storage, the data is objective, but everything else is subjective. And counting the Satoshis or doing all that, I mean, there is always a case to add anything, to do something more, and so on and so forth. But that, as Adam said, the people are getting used to find shortcuts to solve problems, right? Because right now, for example, you would use a blockchain because it's a global shared state, and you have a pointer to a specific information that you consider it immutable. But is it the right way to do it? Probably not. But the reason why everyone is using blockchains to store data, like also doing DNSs and doing all that, is that in a way it's immutable, and you already leveraging on existing consensus. But the designing something that is not blockchain oriented, is still distributed, and is kind of a difficult paradigm shift that not all developers want to get into. People like quick and dirty solutions rather than more complex and visionary solutions. So we see that all the time. And Ethereum is extremely spam. BSV. I mean, I'm the guy that runs the nodes in Bitfinex, and BSV node end up to be like 9 terabytes now. And the problem is that it's of course 9 terabytes are cheap, but imagine indexing that stuff. Imagine the IO that has to have, and when you do an RPC, Bitcoin has all these RPC requests. And imagine like you call an RPC request on a block that has like 1 million transactions. Like the node will take forever to respond because it has to read a ton of data and then compile a huge JSON and send that JSON back to your RPC endpoint. So there are, I think that the effort that that we should always keep in mind is to make sure that we can always keep lean Bitcoin. Of course, again, you can put whatever you want, but also Bitcoin is slow, right? So why the hell you would use Bitcoin for things that are more consumer oriented, right? So it shouldn't be like that. Bitcoin should be like the sacred base layer for human wealth and freedom, rather than being like a transport layer for communicational data or subjective data that would find a better place somewhere else in data structures that are fully peer-to-peer and proven and Merkleized, like the one that Keith is using and Hole Punch are using.
I wonder also if there's just going to be, this is going to be a mountain out of a molehill, because, Rare Toshi, we had, NFTs on Bitcoin via Liquid when the monkey JPEGs were trading for the price of a small condominium, and the Rare Toshi prices were not in that realm. So I just wonder if the Bitcoin community, there's just no demand there for this kind of thing. And I think we're just getting worked up about something that's not really going to have any material impact on the network.
Yeah. I mean, actually, I think these images were done on a weekend. It was like last weekend, right? And the fee rate was quite low. Like the blocks weren't full. The fee rate was like the minimum 1 Satoshi per VByte. And I was calculating, the images seem to be about 150 kilobytes. So I was calculating there roughly like $20 range transactions. But in a week you can get like 10, 15, 20 sats per VByte, and the market isn't very hot right now, right? So, when things heat up in the trading market, typically what pushes the fees up, I think, is actually traders who want to transact quickly because they got to take the trade, right? And so they'll overpay, and then the fees will surge. So, it may be that it will get priced out. I think that generally you want to have like, and this is also why Bitcoin has, these different layer 2s specialized for different things, is you can preserve some of the sort of trustless, decentralized nature of Bitcoin in layer 2s. You can preserve that, for example, in Lightning, right? And so, you could say, well, can't it all happen on chain? And of course, that's the the rationale for Bitcoin Cash and BSV and all these kind of large chains, right? But in my view, the sort of everybody wins if you use the optimal technology for the use case, right? And you see this in the internet protocols. We don't like do voice over IP or video streaming over email because it's it would be horrible, right? It'd be slow, it'd be expensive, it'd be a waste of bandwidth. It's just the wrong architecture. And so I think over time we'll see more. I mean, apart from Bitcoin, the world has now circled back to be much more interested in decentralized and peer-to-peer protocols like Keat. And there was a previous cycle of this, with file sharing apps, but the large social media platforms kind of took over, and the content producers became more friendly to, relatively low cost streaming and making it easier to selectively use things. So they kind of the central systems outcompeted for users who didn't really care about decentralization. But that's come full circle with, all the different media companies interposing kind of editorial control and even the political views of the management or the investors and things like that, and collaborating with, even political parties and governments to try to influence opinion by, filtering and changing posts and things is really quite ugly. So I think that has now, enough of that has become public knowledge that people are quite concerned about it. And so there's a swing back towards decentralizing lots of applications. And of course that requires, clever and efficient protocols optimized for the job, which is what the hypercore transport under Keat is about. Right? I think you guys have been working on that, in fact, for many years, right? So it's really a mature piece of technology. So I think that kind of thing is the future. So it's, Bitcoin is the kind of micropayment and censorship resistant transactions and so on for the internet. But but we need protocols specialized to use cases. And so I think the posting pictures into the blockchain is kind of like the old thing people used to do, which is to chop ripped DVDs up into little teeny hex chunks and post them on Usenet groups, and you'd have to like assemble hundreds of them to like recover this very compressed DVD. But now there are much better protocols for that. So I think that's the future.
Speaking about decentralized social media, we've seen a lot of excitement around Nostr. Are either of you on Nostr? Have you guys played around with it at all? I've seen some of the clients have even added Lightning Network micropayments to Nostr. What's your opinions on Nostr?
Yeah, I like it. I signed up and like installed the client, and asked a lot of questions about how it works architecturally. So not 100%, but I got the gist of how it works architecturally, and I think that's quite interesting because it can sort of bypass the filtering and risk of censorship of the more centralized social media platforms.
Yeah, I like what the guys are doing. I think Jeff is pushing a really good product there. I have from my point of view, I would approach the a new social network, decentralized social network in a different way. I briefly discussed that over Twitter Spaces yesterday. There is a fundamental difference between Keat and Nostr, and although there are similar ethos, so I of course I'm applauding the guys there. Is just from my point of view, when a protocol is using relays by default, it's of course it's just like a back of the envelope calculation, but you could always imagine that if you have X number of users, you would have a square root of the number in terms of number of nodes and relays, right? So and that's basically what the predecessors of BitTorrent were doing in a way. Like you had a donkey, you had LimeWire, they had all these peer-to-peer techniques, but in the end the indexes were all centralized in relays. Everyone could run their own relay, could run their own index, right? So to facilitate inter-exchanges of information. But then it became extremely subject to shutting down those relays, because they were still single point of failures. Of course, they were much better than Napster that came like years before, because Napster was one single point of failure that took down everything. But so I think the technology is evolving to have to make sure to have every single node potentially being a portion of the network, and that is what made BitTorrent extremely resilient, because using the DHT as a system to store and to allow people to pair, so to connect each other, is actually what made BitTorrent different, and what is making, in my opinion, Keat different. So the assumption is that you need to be able to reach out to friends and family and neighbors, whatever, without the need of any central server. Then if you want to have your data more available, you could, in theory, use relays. But in my opinion, relays should be your friends rather than have a fixed set of nodes, because that exposed you to potential, or expose the network to potential attack. Of course, there will be always people willing to run nodes and to take on the risk, but eventually that might be getting harder and harder. So if instead everyone is in fact a node or can relay someone else's traffic, and I'm not talking to big quantities of traffic, right? So you could have, like, everyone is building his own social graph, because you have all these connections, you have your contact list, you have friends, And so it means that you can have, like, you have 100 friends, you can have, you know, the 10 friends more active that they are more online can help you to store temporarily part of the messages that you would like to deliver or are not fully delivered until before you go offline, right? So there are some interesting techniques, but they are, you know, not for sure not easy, and we are still, you know, working in progress on that side, because it's like kind of a paradigm shift in the way you approach the web. Is more subjective web, rather than to have like a single or a recognized set of sources of truths. You have subjective sources of truths that are actually in a certain way a representation, in my opinion, of the human being or society, where, you know, for you rely on what you learn from, or your interactions with other people, and society is all about that. So we are trying to bring back societal behaviors in the way we approach peer-to-peer and peer-to-peer social networks.
Maybe this is a good point to segue over to the Freedom Manifesto. So that was something that was, you know, published last year by Bitfinex. Paolo, can you run us through the main principles and the philosophy behind the Freedom Manifesto?
Adam, in a way, is one of the persons that indirectly inspired the manifesto, right? So in my youth, as a coder, I always look at the, you know, I started coding at early ages, and as soon as the one of the first things I remember was I'm not sure, Adam, if you remember that, but was the Frac magazine. And then you had all the e-zines movement. I wrote for some Italian e-zines talking about RSA encryption, and you know, how you could use it, how you can build in some small libraries that you can use in NRSA. And then I got hooked into how you would break potentially a private public key, and implementing myself all the algorithms to do that, and showing the different system that, of course, you know, with public and private key with like RSA are, you know, extremely difficult, would take enormous amount of time. But I wanted to show that through actual example, through actual math. And so, you know, I've always been excited about, you know, all these publications, and also, you know, there was the Hacker Manifesto that also was a big part of my life when I started, you know, shifting to or learning how to break things and to build things. Like, I always started from the concept that you have really and I usually use the term or the expression that I like to design things that resist the wrath of God, because I spent my life and my early career in breaking things and trying to create, you know, and understand how I could, you know, get around things. And now, so everything that I design, I try to think about, okay, how someone else could try to break this, and you know, so how I can start preventing that. And you know, having a manifesto that actually expresses, you know, your emotions, when your feelings, your philosophy, trying to in a simple way to express why you are doing all of this, right? So why we are in Bitcoin, why we are why we are building Hole Punch, is extremely important, because it shouldn't be just about ourselves, right? So it's also it's also about other people joining in and understanding the movement and understanding how they can help. And so when we decided to write our own manifesto, to me it was super exciting, because it represents our commitment, a company commitment, but hopefully a group, you know, will be expanded to multiple companies. A commitment to freedom of financial freedom and freedom of communications, supporting technologies that require investment. One of the sad things about our industry at large is that there are not many companies that provide capital back to Bitcoin and the Bitcoin similar technologies, and that is extremely saddening, because you get some of our competitors are spending hundreds of millions of dollars on NFT platforms, and I'm not judging NFT as a technology per se, but the reason why that happens, or basically all this Web3 metaverse, no one knows exactly where they want to go with the metaverse, and there are so many definitions of metaverse and Web3 and so on, but there is so much capital flowing in because VCs are getting lured into believing any story and not understanding technology. Actually, just sidetracking, the closest version of the metaverse is, I think, what Hole Punch could represent in the next 10 years. But aside that, I believe that is important for companies that were lucky enough to do well in the Bitcoin space to reinvest in Bitcoin, because no one else would do it for us. No one else is actually doing it, because it's so easy to make money creating a new token, creating selling anything that an algorithm could build, rather than with Bitcoin. In order to get revenues or to increase the value, you have to put a lot of work. It's not just proof of work because there is an algorithm. It's just proof of work because you have to sweat to create adoption in order to give more value to the Bitcoin industry itself. So it's a much bigger commitment that you would ever have compared to what you have in general in anything else related to crypto. So that's why we felt like we should put all this in writing in a simplified format that is less overwhelmed than what I just did.
Yeah, I think it's a really unique mission statement, and probably has a lot of overlap, I think, with what Adam and Blockstream are doing as well, in terms of technology that's supportive of freedom and privacy. So I definitely see a lot of overlap there. What do you think of that, Adam?
It's a very interesting time to be, active in the technology space because of the Bitcoin phenomenon. And I think it's, really inspirational and inspired a whole generation of people to learn about, cypherpunk ideas. There's been a lot more people sort of developing or attracted to that since the arrival of Bitcoin. And, it's there are sort of maybe frivolous or speculative things happening on the sideline, but the actual, core technology and what it enables, and decentralization as a technology phenomena, is super interesting in improving the, sort of balance of power and, self-determination and self-sovereignty and self-reliance that becomes possible economically, and so that individuals can have more control over their life and environment. Because I think fundamentally any kind of hierarchical, centralized, or authority-driven system is inefficient. It's sort of like the failure of central planning as compared to the free market. The free market can try many things and arrive at optimal solutions, whereas central planners don't. It's impossible for them to have enough information to satisfy, the demands and preferences of all the different people in different locations and different viewpoints. So I think you see the same with sort of Bitcoin as a monetary basis for a ground up sort of financial and economic revolution in a way, right? It's a way to opt out of the system, become more self-reliant technologically and financially and in your personal affairs. So I think it really is quite interesting, and the phenomena of the manifesto approach is like a kind of call to arms or something, right? To say, look, this is what we believe in and this is what we're doing, and it causes people to take it seriously and read it and be inspired by it and join into a movement that is ultimately groundbreaking and for the betterment of humanity. I mean, technology waves sometimes are thousands of years apart, and I think it's maybe sounds grandiose, but I think Bitcoin is genuinely a multi once in many thousand years technology evolution. If you think about how long gold has been available as a kind of store of value, even to this day, held by governments and individuals and valued. The Bitcoin is a technological evolution that finally improved the is a better gold, like a digital gold. So I think that is really a transformative and fundamental thing. So to me, it's much more motivating and sort of driving mission to focus on to help make that transition and make the technology scale and provide the security and safety from like data loss and sort of recovery and security balance, to enable as many people as possible to benefit from that. And I think it also, in the earlier stages of electronic cash, there were some centralized systems that people were excited about, but they weren't robust because they were centralized and they relied on central parties. But one of the challenges with anonymity networks was that there was no way to sort of have a micropayment system within them because there was no electronic cash, right? So the privacy networks like Tor and the Remailer network were pretty much operated by volunteers, paying for the bandwidth costs, and it's not very scalable, and it's hard to have quality of service and that kind of thing, right? So with Bitcoin and Lightning and peer-to-peer transports like Hypercore, which integrates basically Lightning micropayments so that you can do quality of service and metering and even provide a business model to content production. I think that's a much stronger kind of technological architecture for the future.
So Adam, 2021 Blockstream launched the Blockstream mining node, which is essentially gave investors access to tokenized hash rate that redeems into Bitcoin on maturation. So we've just kind of passed the halfway point on that. I was wondering, what do you think about the performance of the Blockstream mining node in terms of how much Bitcoin it's accrued? And what do you think of the performance of the Blockstream mining node's mine and hold strategy so far?
Yeah, I mean, I think it gave some quite interesting. The timing of it was quite interesting. So
Yeah.
it picked up some advantage actually from the exodus of mining hardware from China, because that caused a big dip in the hash rate, and so the people that remained online got an artificial boost in profitability for quite a few months there, while that equipment found new homes and power. The hosting infrastructure was assembled in different countries.
That big plunge in hash rate.
Yeah, so I think that kind of accelerated the BMN return profile by 2 or 3 months or something like that. So it's definitely ahead of schedule in terms of what loosely people thought it might have mined based on the difficulty curve that was happening before that. And of course, it took a while, but it came back like maybe about 6 months or something. The hash rate had recovered. But that was definitely a boost for holders. And then, the other phenomena is, I think, as the Bitcoin price fell back, it reduced new investment in hash rate. And then, of course, the relative shortage we were discussing earlier of hosting ready to power up miners has also delayed the hash rate growth. So both, all of those factors have actually helped people who were online and mining. So it's currently mined about 5.8 Bitcoin in the first 19 months, something like that. And so that's actually a bit ahead. And the hash rate is probably still behind the curve, but it's a dynamic system. So I mean, the back testing that we did was that mining provides some upside participation, but also some downside protection. And we understand, everybody understands loosely where that protection comes from. So basically, if things are unprofitable, like if the price falls of Bitcoin and the mining profitability is squeezed, or you end up mining more Bitcoin, or if some hash rate goes on offline due to a political event and you're still mining, you get a temporary bonus. So we got to experience both of those things in the first half, which is kind of interesting.
So where do we go from here? Do you have any other STO type projects in the pipeline or tweaks to the BMN that you're considering?
Yeah, I mean, so we were always interested to make a series of BMNs, so to make another one. Because it's a term instrument that lasts for 3 years, so we're interested to have like multiple overlapping, so there's a kind of ongoing series of them. So the initial one was series 1, so we're certainly interested in series 2. It's a little dependent on the market and the pricing, because currently it seems that people who are hosting miners are paying a premium compared to the BMN price. So it's actually, an interesting strategy to sort of arbitrage BMN against hosting. It's going to complicate arbitrage, but there is some significant spread in there, I think. But so basically demand for the BMN profile tends to be high when Bitcoin mining profitability is surging, and that's basically when it looks cheap in Bitcoin, right? So historically, people bought the BMN at different prices because there were 8 tranches. The tranche 8 was on the Bitfinex securities market, and the other 7 tranches were via stocker placement, and then of course people trading secondarily. As the price ranges they paid in Bitcoin varied between like 4.5 Bitcoin and I think 8 Bitcoin. And so I think like three or four of the 8 tranches are in profit in Bitcoin terms already at the halfway mark. So you can see that the BMN becomes cheap in Bitcoin terms when the Bitcoin price is high. And so then people will use Bitcoin to buy the BMN in anticipation of at maturity getting back more Bitcoin than they put in. And that's already worked out, for some people who at 5.8 Bitcoin mined, but who bought it for 4.5. And there's like 2 or 3 tranches that are in that scenario. So that's quite interesting to see. So yeah, more tranches to follow as the market is in the right balance.
That's not what we anticipated originally too. We didn't expect people to invest in Bitcoin and then make more Bitcoin. That wasn't the idea. The idea was to invest with dollars and then to make more dollars.
Yeah, I mean that was an interesting observation because we could see what people were buying with, and of course the discussion. There's a quite lively Blockstream Finance Telegram channel where holders of BMN and other people interested in the STA marketplaces
and mining modeling and all of that kind of stuff.
Yeah. So they have developed their own theses for predictions and things like that. But the interesting thing that transpired that was not predicted is that most of them bought with Bitcoin with the hope of getting back more Bitcoin than they paid. Whereas really, we had originally done the back testing with the mindset that, well, if somebody is unsure about, it doesn't really have a view on where the Bitcoin price is, will it go up or down? Where is the sort of market feeling that they could do some mining because it has downside protection and it's less sensitive to when you start. But actually the investors were primarily existing Bitcoin holders.
Yeah.
So yeah, and I think on the STO front, we have a couple of other products in development. Some for fairly imminent. Try to get to market quite quickly. One is a Bitcoin mining opportunity strategy, which we'll talk about the details of it. But the idea is that there are some opportunities in a situation with some distress. So every distress is also an opportunity. So we're assembling a discretionary Bitcoin opportunities fund, which we'll talk about more publicly shortly. And then we also have a couple of yield products. One, a US dollar yield in an STO format, and the other one, a Bitcoin yield in the US dollar in an STO format, with a bias towards low risk, actually.
I have to ask, where does the yield come from?
Yeah, that's a critical question to ask because last year has shown.
I don't want to be the yield. Yeah.
Yes.
See what happens in that situation.
If you don't know where the yield is coming from, and it's often very confusing in some of the so-called DeFi projects, that in fact you are the yield. Yes. No. So we do various low risk strategies based on diversification, margin lending, and certainly no because I mean, some of the DeFi was no kind of high risk DeFi stuff. Secured lending is another approach, and there are different arbitrages you can do, but certainly we avoid, concentration of risk on platforms, relying on platforms that are, unknown entrants reputationally in a field, and certainly no DeFi. I believe that a lot of DeFi yield is not really yield in the sense that there's no borrower. It's really actually an airdrop. So Luna was that phenomena. The founders of it had a lot of pre-mined Luna tokens and they paid a 20% interest rate to entice people to put more money in. And as that pushed the price up, they were on the back end selling Luna tokens to pay people an artificial interest rate to incentivize more. So I guess in hindsight, that became obvious to people that was actually a kind of Ponzi or something, right? Fundamentally. So there's a lot of that stuff going around, and we've been. So anyway, I mean, the part of the DeFi and sort of lending problems of last year, and involving a number of industry players in that market that have suffered problems, I think is ultimately down to sort of race to the bottom. So they're always trying to one up each other. Like they'll offer 8%, the next guy will offer 9%, the next guy will offer 10%, and the people running the businesses are not exposed to that risk, and so they have the temptation to sort of gamble with other people's money.
And the users aren't sticky either. They'll chase the yield, so you kind of have to do that.
Right. And so our differentiator, and we have worked on modeling this strategy from before the DeFi failures actually, and our sort of differentiated strategy was to think that actually there is a group of people on the sidelines who are looking at this and thinking that these yields, are nowhere near the risk-free rate. They must have enormous misunderstood risk, and that turns out they're right. And so our thinking was to provide the medium yield, low risk strategy on a win-win formula, i.e. on a hedge fund carry formula, so that it's transparent what the upside is, because not only do some of these platforms expose the customers to risk, but they don't disclose how much of the upside they're taking, right? So the hedge fund carry formula is kind of win-win formula, which is well established as a kind of a way to align interests, and focused on a low risk profile, basically.
I also wonder if some of those arbitrage strategies, if they're more profitable now because so many of those prop trading firms kind of blew themselves up. So the spreads are probably getting wider in some of those things again.
Yeah, actually, it's coincidentally, the divergence between conventional finance portfolio margin rates versus crypto rates has grown, basically because people got spooked by FTX and took, Bitcoins and dollars and stablecoins off of platforms.
I wanted to take it back to financial freedom for my last question. Are you both aware of what's going on in Nigeria and the premium that people are paying for Bitcoin due to the CBDC rollout of the e-Naira and the capital controls that the Nigerian government has implemented? People are paying like 40% more for Bitcoin than they are everywhere else. Do you expect this trend to continue? Seeing that 80% of countries are about to roll out CBDCs, and Paolo specifically, have you seen increased demand for Tether from Nigerians?
In a way, I think that with modern technology, capital controls are going to be more and more a desperate attempt that will, in long term, will fail. People are going to find always ways to protect their wealth. It's not about speculating here, right? So it's not like people want to speculate on Bitcoin; they want to speculate on stable coins. There is nothing to speculate on stable coins also, but there's a way to protect themselves, their families, having a lifeline for saving money, and that's what I think these guys are trying to do. That's why the premium went that up, right? So. And but I think that, of course, initially the capital controls will will create panic. But eventually, as we are seeing in Argentina and other places that have a ton of and huge capital controls, eventually people will get smarter, will understand that there are technologies that will give them more freedom, and they will start using these technologies and these solutions. So I think is like a last desperate attempt from governments. Governments should actually instead focus on trying to understand the technology, trying to understand how to properly use or add options as Bitcoin payments officially recognized if they want to do the good of their own countries.
On Liquid, I don't think that the market really appreciates how cheap and how fast USDT is on Liquid. I did some transaction last weekend sending Liquid USDT from my green wallet to Bitfinex. I think it confirms in like a minute, and I think it cost like 7 cents. So it's ridiculously fast and ridiculously cheap. And when I was doing that, I was wondering if, maybe all the chaos in the markets over the last 6 months kind of brings the original Liquid use case back into focus of, supporting faster, cheaper, more confidential Bitcoin and USDT transactions, given all the chaos that we've seen in the last 6 months. If we'll see a circle back on that and people focus more on that kind of de-risking and using Liquid for that use case.
It's fast because of the block time, and because on a Liquid network, 2 blocks is final in the consensus algorithm, where exchanges will use a different number of block confirmations with Bitcoin depending on maybe the client risk or their own risk preferences. So maybe 3 confirmations or 6 or what have you. And of course, the block intervals can be a bit random. So a main chain transaction could be a bit slower. And I think, Bitfinex is a platform that focuses on sort of power users, bigger traders, funds, and things like that. And so they will often be doing sophisticated trading strategies involving multiple platforms, and they'll need to move liquidity between the platforms quickly or to add more liquidity quickly. So I think Liquid is quite good for that because, the platform to platform transfer, like, in a minute or 2 is pretty good. So it's like human time for trading. And I think the other thing that has been, evolving and been in market for a little bit now on Liquid is the trustless trade technology. So with Liquid, there's a very straightforward way to make an atomic trade. So in Bitcoin, you just, there are coins that go in, the input transactions, and there are coins that go out, and the rule is that the inputs have to add up to the outputs. Now, in Liquid, there is different types of coins, stable coins and Bitcoin and other assets. And so there's a sort of extension to that rule, which is the number of Bitcoin inputs have to add up to the value of the Bitcoin outputs, and the number of, let's say, Tether inputs have to add up to the Tether outputs. But they could be provided by different people and constitute a trade. So I can put in, let's say, 22,000 Tether into a transaction and leave it open to somebody else to put the Bitcoin in and say, well, anybody can take this Tether if you're willing to give me a Bitcoin for that price. And so I can actually, sign that limit order from a hardware wallet and upload it to, a central order book platform, like a Bitfinex platform, and then walk away. Let's leave the limit order there, hoping to pick up a short dip in the price. And if it happens, effectively what will happen is the buyer will put the Bitcoins in and put in their address where they want to receive the Tether, and the transaction gets sent to the chain and cleared. And so it's possible to have the convenience and user experience of a professional trading platform like Bitfinex, but with this technology integration to have a trustless trade where the assets actually remain in the trader's cold wallets, right on a hardware wallet. So we're interested to see the uplift in demand for that kind of thing since the FTX scare. So I think people have become a lot more conscious about platform risk, and Bitfinex is a company that reinvests in technology. One of the first companies to integrate Liquid, to integrate Lightning, and sort of innovative layer 2 things. And so as Bitfinex comes to integrate this type of technology, I think it's a differentiator that it says, look, you can trade on the platform with less trust required, and it could be interoperable between orders on the book that are from traders who have cut funds on the exchange, and people with their own custody, because all that happens is the Bitfinex trading platform basically acts as a trustless trader, matching the hot wallet with the non-custodial limit orders, and so the two markets are could be integrated directly.
I can say that on the Bitfinex side, although we are running an exchange, we always push our users to understand the importance of keeping their Bitcoins in their cold wallets, and so having a way to trustlessly trade is something that we definitely need to explore. We explored it in the past, and is always on our radar, because I think it's part that we discussed before as part of our videos. We really need to have people understanding how this technology works, and exchanges shouldn't be banks, right? So exchanges should be exchanges, and people should be able to understand and educate themselves on how to keep their Bitcoins secure in their cold storage.
That's great.
Guys, I really have to.
Yeah, we're way over time. You're
right.
You want to wrap it up?
All right. Well, thank you both for accepting the interview and coming on the show. It was great asking you a bunch of questions.
Absolutely. Thank you very much,
Thank
guys.
you.
Thanks. Take care.
Indeed.
Thanks.